Welcome to The Explainer. Today, we're jumping right into one of the biggest stories in tech right now, Meta's latest earnings. You've got this amazing growth story on one side, but on the other, the stock just fell off a cliff. So we've got to ask the big question. Is this a classic buy the dip opportunity, or is it a warning sign to sell?
Okay, let's get right into the heart of this mystery. Meta comes out and posts a stunning 26% jump in revenue year over year. They absolutely crushed it. And what happens next? The stock tanks by more than 10%. It makes no sense on the surface, right? But the clues are buried deep inside that earnings report, and that's exactly what we're going to dig up today.
So let's start breaking this down. To really figure out this paradox, we have to look past the scary headlines and just look at the evidence, piece by piece. And what you're going to see is that Meta's earnings report was telling two completely different stories at the exact same time.
And this slide, it just lays out those two stories perfectly. You look on the left, the good news, and you see a company that is fundamentally just firing on all cylinders. Revenue beat, user growth is strong, and that core ad business, it's an absolute money-printing machine. But then you look to the right, the bad news, and this is what drove the whole narrative. A stock crash, Wall Street totally spooked by spending, and a headline profit number that looked, let's be honest, just awful. So let's start right there with that awful-looking profit number. Because this right here is the first major clue. It was basically an illusion that tricked a ton of people who were just glancing at the headlines.
This was it. This was the number that flashed across trading screens everywhere. Earnings per share of just $1.05. Now, keep in mind, the expert consensus was for something around $6.70. So this looked like a total disaster, a complete failure to deliver profit.
But here's the twist. The real profit, the adjusted number, was actually around $7.20 per share. So wait a minute. It wasn't a huge miss at all. It was actually a really strong beat. So how in the world do you get from a $7 profit to a $1 headline?
And the answer is right here. It was a massive, one-time, non-cash tax charge. We're talking nearly $16 billion. Now, this was really just a paper transaction, an accounting move that had absolutely nothing to do with how the business, actually performed during the quarter. It was pure noise that just messed up the real picture of how profitable they were.
And this chart right here just brilliantly shows you how healthy that actual business is. Just forget the accounting noise for a minute. The core revenue engine, it didn't just meet expectations, it flew right past them, coming in at $51.2 billion. That 26% growth year over year tells you everything you need to know. The ad business is booming.
So, if that profit miss was just an illusion, what was the real reason the stock sold off so hard? Because, the market is usually smart enough to look past a one-time charge like that. The real answer? The number that truly sent a chill down investors' spines is coming up right now.
There it is, $70 billion. Now, this is not an accounting trick, this is real money, and it represents an absolutely colossal bet on the future of AI, a bet that has Wall Street completely terrified about profits in the short term. So here's what that giant number actually means. Meta announced it's cranking up its spending, its capital expenditure or CapEx, to as much as $72 billion for the year. And all that cash is going straight into building out a massive AI infrastructure. Servers, chips, data centers, the whole shebang. But the market didn't see a strategic investment. It saw runaway spending that is going to crush profit margins for years to come. And that $70 billion bet, well, it brings us right to the core debate for anybody looking at Meta stock right now. You really have to weigh the company's incredible strengths against the absolutely monumental risks of this long-term vision.
This slide just perfectly sums up that conflict. On the left, in the strengths column, you've got an almost unbeatable fortress, right? A user base of over 3.5 billion people, a really smart open-source AI strategy with Llama, that booming ad business we talked about, and, surprisingly, a pretty attractive valuation. But then you look to the right and the risks are just as huge. That aggressive spending, the intense competition from TikTok, and, a really critical weakness, unlike Apple or Google, Meta doesn't control the operating system on our phones.
A really simple way to think about Meta these days is as two different companies. You've got the family of apps, that's Facebook, Instagram, WhatsApp, and that's the incredibly profitable engine that just prints cash. And it's using all that money to fund Reality Labs, which is the massive, super expensive, long-term bet on building the next computing platform, all powered by AI and smart glasses.
Okay, so
with all of that context, the fake profit miss and the very, very real spending fear, let's get down to the bottom line. With the stock down this much, what is the technical data actually telling us?
The technicals here show this fascinating battle playing out. So on one hand, you've got this MACD indicator, and it's flashing a clear sell signal. That means the short-term momentum is strongly negative. But on the other hand, the RSI is down at 22.2, which is considered heavily oversold. The stock is also hitting a strong support zone, and analyst price targets, they're still incredibly high, which points to a lot of long-term confidence.
So, the crucial point for anyone even thinking about a buy-the-dip strategy is this RSI indicator. A reading this low often means that the panic selling has hit its peak and is probably exhausted. Historically, this is exactly the kind of signal that value investors are looking for as a potential entry point before a stock starts to rebound. So what this really suggests is a kind of two-speed approach. In a short term, say the next 3 to 12 months, the name of the game is cautious accumulation. The stock's going to be volatile while the market kind of digests this new spending plan, but for the long term, looking out 1 to 5 years, the case looks like a strong buy. This isn't an investment in next quarter's results. It's an investment in who's going to dominate AI and the next generation of computing.
And in the end, the entire investment decision really just boils down to this one simple idea. That $70 billion spending plan? That's the price of admission to fight for the future of technology. So the question you have to ask yourself is this: are you willing to stomach the short-term fear and all the volatility to buy into what could be the dominant tech company of the next decade, all while it's selling at a pretty big discount?